Don't worry, we'll let them bring out the CBDCs, the central bank digital currencies, and what do they say? We can have our finger on that button 24/7. You are going to be so off balance with anything they're doing unless you have food, water, energy, security, barterability, wealth preservation, community, and shelter. You need to get those things locked in. In this year, I expect much higher spot gold prices. And no matter what happens with spot gold, because remember, a rising gold price is an indication of a failing currency. And so it benefits central bankers and those that are in power to suppress that spot price. But in the physical only, this is physical only market, we have seen at the upper echelons making way new highs. And even in the area that I personally buy into, still making this trend new highs. Get your positions built while you still have the opportunity. Do you answer this question for yourself. Do you want the central banks to have the ability to just at will? I don't. I want to be able to say to them, too bad, so sad. What you do, it's going to impact everybody. I'm not going to be immune, but I'm going to be more immune because I have especially the only financial asset that is completely outside of the system and runs no counterparty risk, none. But think all of this volatility and potentially those massive, higher than they can expect interest rate spikes. Will that force that Fed pivot that the markets are demanding? Who do you think is stronger, central banks or Wall Street? Guess we're going to find out, aren't we? And all of this. That's why gold is breaking out. And I'm talking about spot. I'm not talking about the real thing. That broke out a while ago. So let's look at this spot market because remember, we've talked about these different toppings, right? 1, 2, 3, 3 tops. A fourth is three is a lot, right? Where it goes up, it hits its head, and then it comes back down, goes up, hits its head. So that's what they're attempting right now, is to further push it down. The way that it works is really simple. When you have a spring, and that spring is held down, so the spot price on gold is held down. When that's released, it shoots in a direction. And that's what it's been doing. And I would consider this, now this I would not say is a pervasive breakout yet, but I would say that is imminent. So this is probably your best and least expensive time to position into this. Therefore, in this year, I expect much higher spot gold prices. And no matter what happens with spot gold, because remember, a rising gold price is an indication of a failing currency. And so it benefits central bankers and those that are in power to suppress that spot price. But in the physical only, this is physical only market, we have seen at the upper echelons making way new highs. And even in the area that I personally buy into, still making this trend new highs. Get your positions built while you still have the opportunity. Are you going to listen to what the markets are telling you?
Lynette Zang, a seasoned financial strategist, emphasizes the critical importance of preparing for the inevitable financial shifts that are on the horizon. As central banks across the globe push towards the implementation of central bank digital currencies, CBDCs, the need for personal financial security has never been more pressing. Zhang's message is clear. If you're not prepared with the essentials, food, water, energy, security, barterability, wealth preservation, community, and shelter, you'll find yourself at the mercy of these new financial systems. CBDCs are being touted by central banks as the future of money. They promise greater control, efficiency, and security. But as Zang warns, with this digital transformation comes unprecedented levels of surveillance and control over personal finances. The notion that central banks could have their finger on that button 24/7 should be a wake-up call for anyone who values financial privacy and autonomy. The role of gold in wealth preservation. One of the central themes in Zhang's message is the importance of gold as a tool for wealth preservation. She explains that a rising gold price is often an indication of a failing currency. Central banks, understanding this, often work to suppress the spot price of gold in order to maintain confidence in their fiat currencies. However, the physical gold market tells a different story. At the upper echelons, where the wealthiest individuals and institutions operate, gold prices are reaching new highs, far exceeding the suppressed spot price seen in mainstream markets. For those who understand the true value of gold, now is the time to act. Zang advises that investors should get your positions built while you still have the opportunity. The window for acquiring gold at relatively suppressed prices may be closing fast as more people realize the potential of gold in a world where fiat currencies are increasingly unstable. The illusion of safety in traditional investments. Zang draws attention to the false sense of security that many people have in traditional investments like money markets and government bonds. She reminds us that during the 2008 financial crisis, many investors learned the hard way that money markets were not as safe as they had believed. The rules were changed to make it more difficult for investors to liquidate their holdings, trapping them in investments that were losing value. In today's environment, with rising interest rates and increasing volatility in short-term funding markets, the risk is even greater. Zang humorously refers to those who believe in the safety of government funds as potential buyers of a bridge in Brooklyn, emphasizing the absurdity of placing trust in these instruments. The truth is that these traditional investments are deeply intertwined with the very fiat currencies that are losing value due to inflation and poor monetary policies. The financial markets are increasingly volatile, and Zang sees this as a sign of the underlying instability in the system. Interest rates may be up, and the Federal Reserve may have some room to lower them. But this cycle of breaking and then bailing out the market can only work for so long. The fundamental issues within the financial system, excessive debt, over-leveraged positions, and the erosion of the dollar's value cannot be resolved by simply manipulating interest rates. Zang points out that the recent fluctuations in the repo markets, where short-term loans are collateralized by treasuries, are a clear indication that the traditional tools of monetary policy are becoming less effective. Volatility in these markets can hinder the central bank's ability to manage the economy, leading to further instability.
They're telling you, get out. But the problem is this stuff too is based on treasuries, the government. What backs it? The full faith and credit, right? So as long as you trust them, you'll continue to loan money to the government. What happens when you don't trust them? Actually, you know what happens? I'll do it with this one because it's bent. This is what happens. It has absolutely zero value, no value. It really has no value right now, even officially, only 3 cents. But you do what you want. I know what I'm doing. The Fed will have to stop its balance sheet runoff or the reverse repo facility entirely drained. At the same time, that money market fund assets rise to new all-time highs. So, you're running into the chicken coop and the foxes are holding the door open and they've got a whole band of foxes in there. I'm telling you, as a chicken, I'm running to the safety of gold. I'm not running into the chicken coop, but a lot of people are. Total climbed to 5.965 trillion. And the sad part is people think that these are safe. But there were a number of people in 2008 that learned that money markets are not so safe. So they changed the rules, making it harder for you to liquidate your money markets. That was the solution. And they drained a lot that was going to corporations. The government drained it into prime accounts that have government debt on there. But that's the public. We already know, I've done videos on this recently, where the long-term holders that don't really care about price fluctuation are getting out of the market, including the Federal Reserve. That's what we're talking about here today. And the public is getting in. Voila, that's what we're talking about here today as well. And you can see this goes back to 2020 with the big spike into interest rates. But government funds, which invest primarily in securities like treasury bills, repurchase agreements, and agency debt, saw assets rise to 4.878 trillion. So you think you're safe in government funds? There is this bridge in Brooklyn that I'd love to sell you. Because you believe this, you're gonna believe that. But I'm going to tell you the truth because I actually don't really own a bridge in Brooklyn, although my father was born there in Canarsie. Okay, so the markets in general sees the Fed's exit from quantitative tightening nearing, which is why you see interest rates dropping down and therefore short-term bond values, market values going up. That's why you see the markets. Markets have been very volatile, but the markets have been going up. The problem is that all of those pieces of Wall Street intangible crap is all based on this. Well, this is my funny money, but basically based on dollars that are also losing value via inflation. I mean, you're experiencing inflation. Is that because those things that you're buying are worth that much more, or that the dollar is worth that much less? That's what it's about. And that's the only thing they have at their disposal, right? So now, hey, interest rates are up, 5.5%. The Fed has room to drop them down. So they broke the broken market that they created. Then they're going to go bail it out again? Well, it only works so many times. Volatility has erupted again. Gyrations in repo rates sent one benchmark to a record in the past week, while the market for short-term loans collateralized by treasuries fluctuated, which means went up and down, up and down, up and down because of that volatility. In fact, volatility in short-term funding markets can hinder central bankers' ability to manage monetary policy. Oh my goodness. Don't worry, we'll let them bring out the CBDCs, the central bank digital currencies, and what do they say? We can have our finger on that button 24/7. You are going to be so off balance with anything they're doing unless you have food, water, energy, security, barterability, wealth preservation, community, and shelter. You need to get those things locked in.
One of the lesser discussed but equally important aspects of Zhang's strategy is the emphasis on community. In times of financial crisis, having a strong community can be as valuable as having a stockpile of gold. Zhang highlights the need for people to band together to share resources, support each other, and build a network of trust. In a world where financial systems are becoming increasingly centralized and controlled, local communities can offer a counterbalance, providing the social and economic support that individuals will need to navigate through difficult times. The idea here is not just about survival, but about thriving in a new, decentralized financial landscape. Communities that are self-sufficient, that have their own local economies, and that are less reliant on the broader financial system will be better positioned to weather the coming storm. This is not just about preparing for a worst-case scenario. It's about creating a resilient way of life that can adapt to whatever the future holds. Zhang returns to the theme of fiat currencies and their inevitable decline. The current financial system is built on a foundation of debt, with fiat currencies being printed at an unprecedented rate. This devaluation of money is not a new phenomenon. It has happened throughout history whenever governments have resorted to printing money to cover their debts. The only difference now is the scale at which it is happening. As fiat currencies continue to lose value, the purchasing power of ordinary people will continue to erode. Zhang uses the metaphor of a crumpled dollar bill, explaining that it has absolutely zero value. Even though the official purchasing power of the dollar is said to be 3 cents, the reality is that its value is diminishing rapidly. The same is true for other fiat currencies around the world. The introduction of CBDCs represents the next step in the evolution of fiat currencies. While they offer certain conveniences, such as faster transactions and more efficient monetary policy implementation, they also come with significant risks. The most concerning of these is the potential for increased government surveillance and control over individual finances. With CBDCs, central banks would have the ability to monitor every transaction and even impose restrictions on how money can be spent. Zhang warns that once CBDCs are fully implemented, individuals will have very little financial privacy or autonomy. This makes it all the more important to have alternative forms of wealth that are outside the control of central banks. Gold and silver, being physical assets, offer this kind of security. They cannot be tracked or controlled in the same way that digital currencies can. As the world moves closer to the adoption of CBDCs, the value of gold and silver is likely to rise even further. These metals have always been seen as safe havens in times of economic uncertainty, and their role is only going to become more important as fiat currencies continue to decline. Zhang suggests that we are on the brink of a major revaluation of gold and silver, driven by their increasing scarcity and the growing realization that fiat currencies are not sustainable in the long term. Zhang also points out that while the current price of gold may seem high, it is still undervalued when compared to its true worth as a store of value. The same goes for silver, which has significant industrial uses in addition to its role as a monetary metal. As more people wake up to these realities, the demand for gold and silver will likely outstrip supply, driving prices even higher. In closing, Lynette Zang's insights offer a sobering but necessary perspective on the future of our financial system. The move towards CBDCs and the continued erosion of fiat currencies signal a major shift in the way money works. Those who fail to prepare will find themselves at the mercy of central banks and the government, with little control over their own financial destinies. However, by investing in gold and silver, building strong communities, and preparing for the basic necessities of life, you can protect yourself and your loved ones from the worst effects of this transition. The time to act is now, before the full impact of these changes is felt. As Zang puts it, get your positions built while you still have the opportunity, because once the shift happens, it will be too late to protect your wealth. As a final thought, remember that while the financial system may be changing, the principles of sound money, embodied by gold and silver, remain as relevant as ever. These metals have stood the test of time, and in the uncertain world ahead, they will continue to offer security and stability.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.